how much of what has worked this year, 22, is going to work in 23?
I think quite a bit. You have to recognize, I think, the context. You know, when we look at the decade or more after the financial crisis, we just had a very long-term secular trend of growth stocks working and outperforming. In fact, it was a decade in which the most expensive sectors and markets continued to get more expensive and outperform, and the cheaper ones got cheaper and underperformed. And that was largely a function of two things: very weak nominal GDP, low profit growth, much better profit growth in the technology sector, and of course record low interest rates, which boosted the value or the premium that investors attached to very long duration growth stocks. And it also happened, of course, during a time when a lot of value areas were facing huge headwinds. You know, banks had to raise capital and delever, and commodity stocks suffered from falling commodity prices. And what we're seeing at the moment is a reversal, but we've only seen, 1 year of reversal from a trend that went on for 10 or 12 years. I don't think value is going to outperform necessarily for the next decade. And in many ways, I think it's probably the wrong way to be thinking about the market now, as a kind of binary split between growth and value. But I think it's going to become more of a hybrid. And we do think that some of these deep value areas are going to continue to outperform as real rates rise, and you get some structural tailwinds rather than headwinds. But I also think the characteristics are shifting as well, and investors are going to increasingly put more value on sustainable margins and earnings and cash flows than they are purely on revenue growth.